Want to invest like a pro? Unlock the secrets to smart investing with our comprehensive guide. Stock analysis is a critical skill for any investor seeking to understand the value and potential of a company's stock. This method aims to determine a stock's intrinsic value, which can guide investment decisions. Dive in and discover how to conduct basic fundamental analysis to make informed investment choices. Understanding fundamental analysis. Fundamental analysis involves examining a company's financial statements, management, competitive advantages, industry conditions, and economic factors to determine the true value of its stock. The goal is to find stocks that are undervalued or overvalued by the market and make informed investment decisions based on these findings. Key steps in fundamental analysis. Study the company's financial statements. The first step in fundamental analysis is to scrutinize a company's financial statements, which provide a detailed account of financial performance and condition. The three primary statements are the income statement, balance sheet, and cash flow statement. The income statement reveals revenues, expenses, and profits, helping investors understand revenue generation and cost management. Key metrics include revenue growth, gross profit margin, operating margin, and net profit margin. The balance sheet shows assets, liabilities, and shareholders' equity, with important metrics like the current ratio, quick ratio, debt-to-equity ratio, and book value. The cash flow statement, divided into operating, investing, and financing activities, shows how cash flows in and out of the company. Positive and growing cash flow indicates long-term sustainability. Evaluate the company's management. The quality of a company's management team can significantly impact its performance. Experienced, transparent, and visionary leadership is essential for driving the company forward and making strategic decisions that enhance shareholder value. Research the management's track record, their strategic decisions, and how they have managed past challenges. Look into the backgrounds of key executives and board members. Assess their experience in the industry, previous roles, and any notable achievements. Management's ability to adapt to changing market conditions and navigate crises is also important. Transparency is another critical factor. Management should communicate clearly and honestly with shareholders about the company's performance, challenges, and strategic direction. Assess the company's competitive advantage. A sustainable competitive advantage, often referred to as an economic moat, helps a company maintain its market position and profitability over the long term. This can come from various factors such as brand strength, proprietary technology, patents, cost advantages, network effects, and high switching costs. Companies with strong moats are better equipped to withstand competition and economic downturns. For instance, a strong brand can command customer loyalty and premium pricing. Proprietary technology or patents can protect a company from competitors replicating its products or services. Cost advantages allow a company to offer lower prices while maintaining profitability. Network effects occur when the value of a product or service increases as more people use it, creating a barrier for new entrants. High switching costs make it difficult for customers to switch to competitors, ensuring a stable revenue stream. Understand the industry and market conditions. Analyzing the broader industry and market conditions is essential to understand the context in which the company operates. Identify the company's position within the industry, market trends, growth prospects, and competitive landscape. Industry analysis involves examining factors such as market size, growth rate, profitability, and competitive intensity. A growing industry with high profitability and moderate competition is generally favorable for companies within that industry. However, it's also important to consider the company's specific position and strategy within the industry. Is it a market leader or a niche player? Does it have a differentiated product or service? How does it plan to compete and grow? Calculate financial ratios. Financial ratios are valuable tools for comparing a company's performance to its peers and industry benchmarks, helping investors assess profitability, liquidity, leverage, and valuation. The price-to-earnings (P/E) ratio compares a company's share price to its earnings per share (EPS), where a lower P/E may indicate an undervalued stock. However, a low P/E could also reflect market concerns. The price-to-book (P/B) ratio compares market value to book value, with a lower P/B suggesting undervaluation if fundamentals are strong. Return on equity, ROE, measures profitability relative to shareholders' equity, with higher ROE indicating efficient use of capital. The debt-to-equity ratio assesses financial leverage, with lower ratios indicating less risk. The current ratio measures liquidity, with ratios above 1 indicating good liquidity. Perform a SWOT analysis. Conducting a SWOT analysis provides a comprehensive view of a company's internal and external factors that could impact its performance. Strengths include advantages like strong brand recognition, proprietary technology, skilled management, and robust financial health. Weaknesses are disadvantages such as high debt levels, reliance on a few key markets, or operational inefficiencies. Opportunities are external factors like market expansion, technological advancements, favorable regulatory changes, or shifts in consumer behavior. Analyzing a stock. To illustrate fundamental analysis, let's analyze XYZ Corporation. The company's financial statements show consistent 10% annual revenue growth and an increasing net profit margin from 8% to 12% over 5 years, indicating improving profitability. The balance sheet reveals a current ratio of 2.5 and a debt-to-equity ratio of 0.4, suggesting strong liquidity and manageable debt levels. Positive operating and free cash flow support growth initiatives and financial stability. The CEO has 20 years of industry experience, and the management team is known for strategic vision and transparency. XYZ Corp's strong brand, proprietary technology, high customer retention, and extensive distribution network provide a sustainable competitive advantage. Operating in the renewable energy sector with robust growth due to increasing demand for sustainable solutions, XYZ Corp is well-positioned with a diverse product portfolio and growing market share. Favorable economic conditions with rising GDP, low interest rates, and high consumer confidence support continued growth. The P/E ratio of 15, below the industry average of 20, and a P/EB ratio of 1.2 suggest potential undervaluation. With a ROE of 18%, debt-to-equity ratio of 0.4, and current ratio of 2.5, XYZ Corp appears financially healthy. Strengths include a strong brand and solid financials. Fundamental analysis is a powerful tool for investors seeking to understand a company's true value and make informed investment decisions. While fundamental analysis requires time and effort, the insights gained can significantly enhance investment decisions and potentially lead to better returns. It's important to remember that no single metric or analysis method is definitive. A holistic approach considering multiple factors provides the most reliable results. Thanks for watching. Don't forget to like and subscribe.